Hello, everyone. I'm glad everybody was able to get on. We are getting ready here to start our very first Rubicon Advisors webinar. And I can see that everybody's logged in, and we'll probably get some more people logged in as we go along here. But just wanted to start off with a couple of little housekeeping items. So to hopefully make this webinar series that we're going to be doing going forward beneficial, and one that you'll want to take time out of your day to be a part of. So a couple of things here. Throughout the presentation today, we're going to have a couple of polls. So on your screen on the right hand side, you should see kind of a white box area for chats and polls and handouts and stuff. You will be able to answer those polls, and a couple of them have to do with the presentation today. Other ones have to do with just how this webinar went, and helping me get it better and get it designed a little better as we go along here. And as you see, I see somebody already chatted with us. So thank you, Joe, for finding the chat button. So all the chats are private. So we as the presenters can see the chats, but if you ask a question, I don't believe anybody else will be able to see your chats. So those can be private for us, but feel free to ask questions as we go along here. And I have no problem interrupting our presenters to be able to get those questions answered. So, and then there are a couple of handouts that we're going to be having here. So, but that being said, wanted to start off our first webinar series with Alger funds. Now, as of today, we're not going to go into product in depth, as we're not really allowed to do that in this kind of setting. But Alger funds is a great product. Everybody on the call today owns Alger funds in their portfolio. And again, at the end, if there's more specific questions on product, you can ask me, and we can do more of a one-on-one call. But Sean Jacobus is our regional, what we would call wholesaler. He represents Alger funds to Northern California. And so he's my guy when I have questions in regards to how's Alger doing? Why are we, why is the market down? Why are things going on? Sean is our guy that we go to and talk to about that. So I'm going to let Sean introduce our presenter this morning, as well as just give a little background about Alger, and we will go from there.
All right, Brian, thank you so much for having us, and to all your clients out there today. Really appreciate you the opportunity to speak to you guys and talk to you about what's going on in the capital markets. So my name's Sean Jacobus. Again, I live in Marin County. So I'm a Bay Area local here in Northern California, and been working with Alger for the past 7 years. Couple things, you may say, who's Alger? Never quite heard the name before, unless I'm looking at my statement that Brian sends me every month. Well, a couple things about Alger. One, we're a family-owned firm, and on Wall Street, I think that's important. I like to say we're not the Walmart supercenter of asset management. We're a growth equity boutique, and what Alger specializes in are some of the most innovative companies in North America. Now, the relationship we have with Rubicon is we specialize in domestic American companies in a smaller capitalization. So think of companies in the $1 to $20 billion range. That's really our niche. We're about 58 years old, and we've had a long New York history. The firm was founded by Fred Alger, run as well by his brother David Alger. Sadly, we were one of the firms in the World Trade Center where we lost almost all our employees and 2/3 of our assets. But as somebody from New York, and my colleague Art is also from New York, it's a New York success story. The firm was left for dead, and we recovered, and people came back to the firm because they didn't want to see Alger go away. And today, I'm proud to announce the firm runs about $35 billion, one of our all-time highs. So Alger, again, is thriving and one of the premier growth equity managers on Wall Street. So what we're going to talk today about is the capital markets. What's going on in the market, and my colleague Art Nowak. Art, thank you so much as well for joining us. Art works on our product management team, works with all our portfolio managers. He has a CFA, which means he's really smart. That's what a CFA means. You're really smart, something Brian and myself don't have. Anyway, Art works with all our portfolio managers, and what we're going to do today is just kind of give you a little insight of what we're seeing occurring in the stock market today, where we're seeing rampant innovation, and where we think there's some opportunities going forward. So Art's been with the firm going on 10 years. He has a lot of experience. Art, really appreciate you joining us today, and thanks for coming on to join us with Rubicon.
Yeah, thank you so much, John, and really appreciate the opportunity to be here, Brian. I think the main thing that we're going to talk about today, and some of the data points around it, is staying the course. I think we've all been through a lot of hurt over the past 9 months in terms of the equity markets. I know there's a lot of questions about inflation and interest rates and volatility in the equity markets, both here and abroad. So just to start, I think we ultimately believe that inflation will moderate from this very high level. It's still too high. We've seen some cracks in inflation just in terms of used car prices. We've seen some inventories start to rebuild. But what's really propping up inflation is the housing market, which is about a third of total CPI or 40% of core CPI. And it's, in our opinion, we think it's more likely to accelerate than decelerate over the coming months. So what does that leave us with? That leaves us with tighter monetary policy. And what can we expect from tighter monetary policy? Over the last 60 years, the Fed has raised interest rates 11 times. And of those 11 times, only 3 or 4 of those were soft landings. So interest rates that didn't lead to recessions. And we say 3 or 4 because we don't really know what would have happened in 2015 to 2018 because of COVID. It could very well have been a soft landing. So in the mid-60s, the mid-80s, and 1994 and 95, the Fed raised the rates in response to economic overheating without precipitating a recession. And all of those 3 periods, they raised rates by around 300 basis points, which is what we're looking at right now. It's estimated that the Fed will raise rates close to 300 basis points. But still 4 out of 11 in terms of soft landings versus recessions is decidedly mixed odds. So we think that we'll be facing an increasingly volatile backdrop. We've seen the markets kind of relax over the past couple of weeks. But in this presentation, we really want to talk about the pitfalls in market timing, the benefits of staying the course and staying invested, and most of all, reiterate that market volatility does not impede the powerful march of innovation, which we think generates wealth over the long term. So I want to start off with a quick poll question, and that's: do you think asset allocation can be market timed to produce superior returns? And Brian, if you want to pop that poll up, that would be great. All right, that's pretty good. It looks like we're at 100% no, which is definitely what we want to see. And so I think the first 2 slides really kind of delve into behavioral science and the background of behavioral finance, just because it seems if people left to their own devices and try to, or their own devices and try to time the market in general, they get it wrong.
Hey, Art, I'm gonna jump in real quick here. We do have one answer that was a yes on that, and I don't think that's necessarily the wrong answer. I think The reason why
Sure.
people would answer yes in this reason, and again, just so everybody knows, I don't know who answered yes. I don't know who said no. So the poll questions are private even to me. So, but I think the reason why someone would answer yes is I think when the market is having difficulty and things are getting smacked around and that sort of thing, I think it is our human nature that we feel like we have to be doing something. That if we're not just waiting, that we have to be doing something. So I think that's always kind of that fear of going, well, I think I can market time it. And in our minds, it's not market timing. It's I'm just doing something. And so I think I want you to know, I don't think that's a wrong answer. I think it's just our human nature steps in and says, hey, everything's going really bad. Everything's having difficulty. I have to be doing something. And if I'm not, then maybe I'm not doing what I should be doing. So just want to add a little bit in there. So.
Yeah, absolutely, and I think that's that's what we want to push across. I know I have my own experiences looking at my own stocks and mutual funds. When it's going down, it doesn't feel great. But so for this chart, what this represents, the blue line represents the amount of money in trillions of dollars in money market assets over the last 15, 20 years. And these red dots represent, Brian, can you see my marker on the screen or?
No, I cannot.
Okay, I'll just talk through the chart. The red dots represent troughs in the equity market. So as you can see, this is 2008. This was the global financial crisis. People started to take money off the table as the market was going down, and it kind of peaked. The amount of dollars in money market assets peaked right before the bottom. So in 2009, when the money market assets peaked, the stock market was bottoming, and there was a lot of cash on the sidelines that missed out on excellent returns from then on. So from March of 2009, the 1-year return was 47%, and the 3-year return was 77%. But unfortunately, there was $1.4 trillion in money market at the time. In 2016, we had the China currency devaluation, we had Greece default, and which is the second red mark on the graph. And so while we didn't see a huge spike in money market assets, you did see people move cash to the sidelines at an inopportune time. So the 1-year return from that second red dot from that period was 22%, and the 3-year return was 44%. And then we saw something similar at the beginning of COVID in March 2020. And so with COVID, there was certainly a lot of fear in the marketplace. So the third red dot, that's kind of the beginning of COVID, March 2020. But as people moved cash from the sidelines and moved cash to the sidelines, the market bottomed out. And from the peak here to a year from that, there's been, or until now, there's been a 75% appreciation. So I think the lesson here is investors often sell risky assets and build cash at the wrong time through no fault of their own. I think a good example of this would be the VIX. So the VIX is something that we like to refer to as kind of a fear index. What it represents is the predicted volatility over the next 30 days. So the more volatile the markets, the more fear it is. The more fear, the higher the VIX is going to be. And we think just when investors are feeling fearful, it's often the case that the best returns are to be had, and vice versa. So what this chart looks at is that at the bottom, it has the price of the VIX, and at the top, it has the average 1-year return over the past, I believe, quarter century. So if you look at above 40, that's when fear is very, very high. And as you can see, the average 1 year return from any day where the VIX was above 40 was about 36%. And 35 to 40 VIX is still very high. The average is 25%, and it goes down from there. So I think what this shows is that the best time to be buying into the market is when there's a lot of fear. So the highest that we've seen in the past 3 decades, the VIX shot up all the way to 82, was on March 16th in 2020. And as we saw on the last slide, that was the beginning of COVID, when states were declaring emergencies and schools were shutting down. The 1 year return from when the VIX hit 82 was 69%, so almost 70% on a 1 year basis. The second highest was in November 2008, which was the global financial crisis, which 2 months after the Lehman collapse, the VIX was at 80. And so 1 year after the November 2008 period, there was a 49% return in the markets. And anytime, this is interesting, anytime the VIX has been greater than 50, we've never seen a negative 1 year return. So anytime the VIX has been very high, anytime there's been a lot of fear and a lot of negativity and volatility in the marketplace, the VIX shoots up. And when we've seen it get to elevated levels, we've never seen a negative 1 year time period return after that. So I think what this slide shows is that when fear is high, the impulse is to sell. And that is typically when risk premiums are highest and actually a good opportunity to invest in the market. So, I think the first 2 slides really show, talk about some of the issues that we all have in terms of our decision making, and the best way to, get away from those fears is by staying invested, and that's how you take advantage and participate in those upswings after we see downward.
Yeah, and Art, that's really good. I think it's important to know about the VIX. I started really watching the VIX back in 2009 and 2010, seeing how it related to everything. Just for you to know, as of this morning, the VIX is up a little bit today, but we're at $24.69 for the VIX. So we're well under any sort of like 2008 type levels in the VIX, and so that is something I continue to watch as we're looking at portfolios and different directions to go. So it is one of my indicators, but I just think it's as we go along and have this fear conversation, let's continue to put things in real world perspectives, even though we're looking historically to say, okay, yeah, in 2008 the VIX was at 80. That was a scary time. We're scared today, and so the VIX is significantly less, like less than a third. So of that. Right.
So that lower VIX level, it really shows that, they're predicting lower volatility and maybe a little breather from what we've seen over the past 9 months over the near term future. So let's talk a little bit about drawdowns. And I think, drawdowns are of course inevitable, and they're tough to bear through. And I think, people have unless it's something like 2008, or, the dot-com bubble, people have kind of a short-term memory like this. Like, I don't really remember the 12% drawdown in 2015, but, they're inevitable. And we actually look at this from a little bit of an Alger spin. So we looked at the Russell 3000 growth. Over the past quarter century, the median drawdown is 12% on a year-by-year basis. So you're normally getting a double-digit drawdown on any given year. And many of those years where you get very large drawdowns, you actually get very large overall returns for the year. I think a good example of that would be 2020. We had a 32% drawdown, but we ended up, well over 30% for that year. We had excellent returns. And so that's what the left side shows. On the right side, it shows the drawdowns of the 10 best performing stocks, growth stocks. So if you use hindsight and look back at the best performing stocks in the Russell 3000 growth over the past 5 years, you would still have huge drawdowns in any given year. So in November of 2018, you would have had a 25% drawdown. 2020, which we just talked about, it would have been 42%, and 21, 22, you would have had 46%. So even the best stocks in the market are victims to significant drawdowns in any given year. But what that shows is that just because the stocks or funds go against you, it doesn't mean you're in the wrong stocks or funds. You literally, if you look at the right, the graph on the right, you literally couldn't have picked better stocks than in this chart, but you still had to endure a lot of pain to hold on and recognize these long-term results. And as you can see, if you held these stocks over 5 years, despite these big drawdowns, you'd be returning over 3,000% over 5 years. So we don't think drawdowns are necessarily a reason to sell. We think the reason to sell or add to a fund should rely on the fundamentals and what the fund looks like, its makeup, which is something we'll talk about shortly. So going to the next slide. So I think this is a precursor of what we want to get to in terms of innovation. We want to talk about what drives the stock market, what drives real wealth creation, and we think it's important to look at on a long-term perspective. So on the left, this is PE. So what that is just the price of stocks divided by their earnings. And as you can see, it's all over the place. It's been very volatile. And we think that PE is analogous to sentiment. And as you can see, sentiment moves all over the place year to year. There's not really any trend to PE. The prices are reacting to short-term movements within the marketplace. But as you can see on the right, the blue line is the S&P 500 earnings per share. And the light blue line is the S&P 500 price. And as you can see, there is a very, very high correlation between earnings per share and the overall price of the market. In dark blue EPS, it was about $1 in 1945. It's currently well over $200 of earnings per share in the S&P 500. In 1945, the S&P was at about $10. And what's very interesting about this EPS over this post-World War II period, going back to 1945, is that it's up 7.3% annually. And that's basically matching the S&P 500 price index, which is up about 7.5%. So obviously what drives the price of the overall market is earnings per share, not these short-term kind of sentiment headwinds or tailwinds. And so, EPS and S&P 500, they're both up nearly the same amount over this 1945 to now time period, which encompasses many different market cycles. And incidentally, there's been a huge amount of wealth creation over that time period. So over that time period, it's been about 200 times, or up 200,000 or 20,000%. So these things that we worry about in the present times, these market cycles, they're obviously important on a near-term basis. Something like a recession, it's going to hurt. It's going to, it's going to be tough to stay invested through. But they're really dwarfed by the larger context of wealth creation over time. And if we look at the 1973-1975 recession, that was a doozy. One of the most severe drawdowns in the stock market, and economically speaking, until we got to the global financial crisis. And so the S&P at the beginning of 1974 was at 100. and it dropped to 60. So that was a 40 point drop in the S&P 500. So that's a 40% loss. This was a tremendous drawdown that caused a ton of pain. But to put that in perspective, the stock market has grown so much since then that 40 point move it's basically a 2 or 3 day move in the S&P 500. It's something we don't even feel anymore. So the market has gotten so large that, you know, movements that were devastating in 1974 are a blip on the radar to us. So the overall thesis here is that, yes, you know, short-term market rotations are often painful, but in general, the market is you know, it's really driven by earnings per share. And you know, so while we move forward, you know, these moves that we worry about all so much, you know, whether we should be invested in cash or how should we be allocated, you know, our view is that we should really let our capital work for us and invest in the most innovative companies that are growing their EPS share on, you know, a 15 to 20% annual basis. So right now, Brian, I'll ask you to pull up our second poll question. You know, if earnings drive stock prices and GDP drives earnings, our second question is, what drives the long-term GDP? And we have 4 choices here. Is it the unemployment rate, fiscal monetary policy, productivity, or import-export trade balance? And remember, there's no wrong answers here. So, you know, whatever you think. All right, let me give it one more second. Yeah, so we have a couple of answers, some in fiscal monetary policy, some in the import-export trade balance.
Well, I was just going to say, yeah, they're still answering. So I think people are taking their time to really, you know, and no cheating. You can't Google this. No cheating. So
sure. Yeah. I'll give it one more second, see if anything changes. Yeah, so we have a split between fiscal and monetary policy and the import-export trade balance. And I say there's no wrong answer here, just because these are all, you know, extremely important: unemployment rate, the monetary policy at the time, productivity, import-export trade balance. But you know, the answer is actually, you know, productivity. So earnings drive stock prices. We laid that out in the last chart. GDP drives corporate earnings. So gross domestic product drives corporate earnings. And we've done studies in the past that show there's a high correlation between GDP and the S&P 500 sales. And as you can see in this chart, the blue line represents productivity, and real GDP is essentially driven, and the light blue line is real GDP. And you can see there's a significant correlation between the productivity and GDP. So we'll say that GDP is essentially driven by productivity.
So, Art, I'm going to ask you a quick question. And again, I want to remind everybody, if you have a question, put it in the chat, because we want to be able to ask Art some of these questions while we have them here for us today. So is this where maybe, I know we had employment on there as one of the questions for the polls, but is that where one of the, when we look at underemployment, right? When people can't get enough people to work their business, you know, let's say they have a restaurant or something, they can't get enough wait staff and therefore they have to cut their hours. Is that what you describe, what really that productivity means? How do they describe that? What is that productivity?
Yeah, so we essentially describe it as the labor force, how much their output per hour multiplied by their hours worked. And we do think that it kind of gives you your long run GDP. So it's based on the amount of output, and it's based on the number of hours worked. So I know, you know, there's situations where there's underemployment. So, you know, the amount of hours worked may come down, and that generally we see a drop in productivity. And generally when we see a drop in productivity, we'll see a corresponding drop in the real GDP. So, you know, when restaurants can't find people to staff, you know, their revenues are probably going to be affected. Their profitability is probably going to be affected. And, you know, that rolls all the way up to our top line GDP.
Good.
So
that helps. Thank you. Thank you. I think a lot of times we forget really what productivity means. So.
Yeah. So on the chart, the yellow lines represent recessions. The dark blue is the output per hour, which you can see is A, very steady, and B, pretty much tracks real GDP over time. And what's interesting is that even in recession years, productivity has on average grown about 2.2% year over year. So, you know, productivity really marches forward irrespective of what's happening in the economic cycle. So regardless of what the Fed is doing, you know, and a lot of that has to do with innovation. It's new products that boost output, that boost productivity. And so we have these big picture drivers of stock prices. Again, it's earnings drive stock prices, GDP drives earnings, and productivity drives GDP. And, you know, productivity, like you just said, Brian, is kind of an economist term. And it may be not so clear what we're talking about. So I kind of want to give you a concrete example that I think will be helpful. And this example goes back over 200 years. So, you know, artificial light is something that's critical for all of us, for everything from our jobs to our ability to live productively, to our ability to, you know, relax after work. And no one wants to stop living their lives because the sun goes down. And we've been fighting against that since fire was invented. So we need artificial light. And in 1800, you know, we had a candle that was made of animal fat, so tallow. And this chart shows you how many hours of light you could purchase from that candle from 1 hour of work. So using the income from 1 hour of work in the 1800s, you could purchase about 11 minutes of light using that candle. Kerosene was introduced around 1880. And so that boosted, quote unquote, productivity of our artificial light. And so once kerosene came around, the income from 1 hour of work could purchase 4 hours of light instead of 11 minutes with a candle. So then the modern light bulb came onto the scene in the mid 20th century, around 1950. The income from 1 hour of work increased its purchasing power from 4 hours of light to 531 using the incandescent bulb. Modern day, so today, 2022, LED bulbs are available. I don't have any in my apartment yet, but I'm looking forward to getting some. And even though they're more expensive than incandescent bulbs, they're so much more efficient that one hour of work can purchase 13,100 hours of light. So think about that. In 200 years, the productivity of our artificial light went to us being able to purchase 11 minutes of light with 1 hour of work to over 13,000 hours just because of technological changes. That's a 70,000-fold increase or a 5% annual productivity growth over 5 years. And that's the essence of productivity and why we live better than our grandparents did. It's doing more with less. And we can see these trends with many other things, you know, wireless telecommunications, the introduction of cell phones, information storage, et cetera. So, you know, productivity is not only an output of, you know, manual labor and people working. It's also a product of change and technological advancement. And so we like to say that, innovation is absolutely accelerating over time. And many of our portfolio managers here at Alger will tell you that this is the most innovative time in history. Just like the last slide, these slides show how innovation is accelerating. So cable TV and the washing machine, that took 40 to 60 years for 50% of U.S. households to have access to either cable TV or washing machines. With the internet, it only took 14 years. Social media, only 9 years. Smartphone, even faster at 7 years. So, that's creating great disruption for new and innovative products and services. And the time from introduction to a product to a 50% penetration of U.S. households is only accelerating. So that's the left chart. On the right, it shows the years to reach 1 billion users. And so we're moved up a little in time. And, we're looking at Microsoft Office and Microsoft Windows. It took them nearly, 25 years, so roughly a quarter of a century to reach 1 billion years. Now that is accelerating even faster. Things like YouTube and Google Chrome have taken less than a decade to reach a billion years. I don't know if there's any TikTok users on the call, but TikTok did it in only 5 years. So that accelerating pace of innovation is continuing, and we think it will continue in the future. And we think there's a lot of financial implications from this as well. We think it's a tailwind for growth stocks, which are the drivers of this innovation, and a headwind to value stocks that may be victims of change. I think a good example of this would be newspaper stocks. I think if you looked at the valuation of newspaper stocks a decade ago, a lot of the market and analysts out there thought they were cheap. Now most have gone out of business in the last 10 years. People's attention went from print to online very quickly. And the fundamentals deteriorated rapidly in that group. And I think it's one of the two main reasons that growth has outperformed value so significantly over the last 10 to 15 years.
So Art, I think the question on all of our minds then is, what's the next one? What's the next product to reach 1 billion users, or even what is currently? We see the smartphone, we see social media, internet. What's that next product that's kind of starting to penetrate people's homes?
Yeah, I think the buzzword that, and I'm trying to think of the exact word, but it's the idea of VR. I think a lot of people are starting. The word is the metaverse. Facebook is putting billions and billions of dollars a year into research and development in this. And I think the idea behind it is, people will be using virtual reality to not only play video games, which is basically what people use it for now, but to, set up shops, set up online shops, set up communities, things like that. So I think a lot of people are predicting that the next thing that's going to come out and really disrupt the market is the metaverse. And that's kind of one of the main buzzwords going on Wall Street right now.
Good. No, I just think good.
Go
That's interesting. So.
Good. Yeah. So, on this chart on the left, we have the S&P 500 net margins, and I'll explain that pretty briefly. So, net margin is basically sales minus cost of goods sold. So the higher net margin a company has, the better and more efficiently they're operating. So you want companies with higher net margin. And as we've seen this acceleration in innovation, we've seen net margins correlate with that and accelerate over time. We think that's pretty important because the changes in technology out there are allowing companies to scale quicker. They're allowing companies to run more efficiently and be much tighter in terms of how they're operating. So we think that innovation is really allowing companies to be very, very, very much more efficient than they were 30, 20, or even 10 years ago. We've also seen return on equity over time, which is the right chart, accelerate over the last 30 years. And what ROE is a gauge of is a company's profitability and how efficiently it generates those profits. So currently it's at about 20%. Over the last 30 years is close to 15%. So companies again are becoming much sleeker, and they're becoming much better at taking their sales and turning those into earnings and profits for their shareholders and their investors, like everybody who's on this call today. And so we think that this slide demonstrates the financial impact of the accelerating pace of innovation over the last 30 years. So let's finish off, this kind of area with, the benefits of long-term investing. Not hopping in and out of investments. As things change in the marketplace. So this slide is just the overall very big picture of the benefits of long-term investing versus the risks of short-term market timing-based investing, and this is based on data from 1950 to 2021. And what this chart shows is the annualized returns based on investing for 1 year, based on investing 5 years, based on investing 10 years, and then based on investing 20 years. If you're a short-term investor and only investing for one given year, stocks are very risky. You can see that in the first blue line, all the way on the left. You can see that wide gap. So, a 1 year return could have either given you 52.3% positive return or a negative 37% return on the minimum side. So, that's a lot of volatility in a 1 year return. That's over, close to 90% gap between the high and low. And bonds, they're less risky over a short-term period, as you can see the light blue line here. But as your holding period lengthens and you become a longer-term investor, what you see that the range for stock returns dramatically narrows to the point where the standard deviation over a 20-year rolling period is actually lower for that of bonds. So the longer that you're invested in stocks, the risk tends to get less and less. And also the minimum returns in stocks is significantly higher over that 20-year period. This is the two bars all the way to the right, than the minimum return in bonds. And it's one of the reasons that we've argued for, obviously Alger is a growth equity company, but it's one of the reasons we've argued for higher allocations to stocks and lower allocations to bonds. So that's basically the first section I wanted to cover, and we can finish up with some kind of macro. But I want to make sure that what you take away from the first number of slides is that market timing has not worked out well for retail investors. I know that's everyone's instinct. It's my instinct. It's your instinct. But the data doesn't support that market timing works. And they've historically had large amounts of cash on the sidelines, right when the market tends to bottom and start going back on its upward path. The second thing I want to take away is that, volatility and fear in the markets can create opportunities for the near future. We saw that with the VIX. The higher the VIX is in general, the larger the 1 year return has been over history. And that, the third thing, long term, the markets are driven by earnings. Earnings are driven by GDP, and GDP is driven by productivity. So GDP and productivity have been remarkably stable over the long term, regardless of what short-term actions are happening in the market. So, at Alger, we feel that understanding that, there are going to be, short-term disruptions, but, it's always better to be long-term holders and not trying to market time. And, you should be investing in innovative companies that have high earnings growth and have a long recurring revenues and a long pathway ahead of them. And the fourth thing that I wanted to get across is that the accelerating pace of innovation is only getting more rapid. And we believe growth stocks that Alger invests in are a great position to take advantage of that acceleration. And so before I kind of end up with some kind of macro thoughts, do you have anything else to add?
No, we have about 15 minutes here. And so again, we want to be very cognizant of everybody's time. So wanting to keep these no more than an hour. So please post your questions. This is the time where we can start answering those questions. Give you a couple of minutes to do that, and then we'll have Art finish up here, and then we'll do some end of meeting housekeeping items. And we got a couple more polls that we're going to be putting out there here in a little bit. So we'll have Art finish up, but please get those questions in, and we can answer those for you. So and again, don't worry if you don't really know what to say. Just I can kind of interpret it. I know you guys well, so just ask the questions.
Yeah, and I'll keep my comments brief, just so we can, in the interest of your client's time. So let me know when you want to get started on some future-facing macro.
It's still crickets, so you can kind of finish up on your micro side or macro side, and we'll go from there.
Hopefully that means that people are understanding. I hope that's what it means. So let's talk a little bit about the future and kind of where we're seeing, markets going. I know, we talked a lot about, how things have reacted in the past over this call, but we also want to give you kind of what we're thinking, an overall view of how we see the economy and some stats that you might find interesting. So we do see some tailwinds. So I think there's a lot of, negative headlines out there, but, we do think that there are some positives to the overall market out there. And the first being, very, very robust consumer savings. And I'll go through a slide on that in a couple minutes. We're also seeing growing corporate profits. We're also seeing the potential for inventory rebuilding. I know a big buzzword over the last couple months was supply chain. We are seeing some easing there. We definitely see a strong labor market where participants have they're in charge of where they work, and we do see some recovery in some depressed economic areas, that were brought down because of COVID, as we move through reopening in fits and starts. On the headwind side, we've talked about tighter monetary policy, rising interest rates. That's the chief issue right now. That's what's roiling the markets. We're seeing inflationary pressures. Incomes are not keeping up with inflation, so that's causing a decline in real purchasing power. Over the last few years, we had tremendously large fiscal stimulus. We had all those checks going out to pretty much everybody in the U.S. That's being reduced, which is a headwind to economic growth in the short term. However, long term, I think that's probably a positive. And we're seeing some different COVID variants in Europe and China. China growth, which is causing a growth slowdown in China. I will say, since this, that the capital markets was printed, we've seen a lot of easing of kind of the lockdowns that were in China, which is helping growth come back, which is helping, the supply chain issues that we've been seeing in the U.S. I think the big buzzword is the Ukraine-Russia war, and it complicates everything. And it's putting upward pressure on inflation and downward pressure on real growth. There's a huge amount of wheat that's produced in Ukraine. In Europe, Russian oil they have a huge dependency on that, and they're taking plenty of steps to try to reduce that. But we still believe that in spite of all those economic things, to say nothing of the human toll, that the global supply chain pressures are easing and inflation is moderating. And so we believe that inflation is still high, but in the next 12 months we could see some even deflationary areas in the goods side of inflation. And so, so we were just talking about the supply chain pressure, and on the left here we have the New York Fed's estimate of supply chain pressure. So that's kind of how tough things are to get on the supply chain. And as you can see all the way on the right of the supply chain graph, it has eased somewhat since November. Deliveries have started to improve somewhat. Inventory levels have improved somewhat. And this is data that has come out since the war in Ukraine and Russia has started. So in spite of that, we've seen some easing of, sorry, I was just looking at the chat, with some easing of that supply chain. Things like used cars, which is part of CPI, which is what drives inflation. Those prices have come down significantly. They drove up. They were driven up during COVID because everybody wanted to be able to drive everywhere. We're seeing those start to come down, which will help moderate core inflation. So our view is that even though because of the war, energy prices may stay elevated, metal prices may stay elevated. You think this would be horrible for used cars, and you'd be right. But however, semiconductor chips and other supply chain components are starting to free up. So we could still see a moderation of inflation and a moderating impact on prices, despite the fact that raw materials may stay elevated for a short period of time. On the right here, this is the inventory levels relative to history. So, the inventory levels for companies are currently at 1.25 sales. So think about that. For a year of sales for a company, they currently have 1.25 times that in their inventory. So they're very low right now. Over the last 10 years, on average, it's been about 140%. So, and the way to think about that is, if the supply chain pressure subsides, we could see a potential increase in what are now very low inventory levels. So the way to think about that is that if inventory levels improve from where they are right now, which is 1.25 their yearly sales, to their average of 1.4 times their average the yearly sales, that would imply in $250 billion in inventory build, which would add over 100 basis points to GDP. So we've seen inventory come down after COVID and supply chain pressures, but even it just returning to its normal levels of 1.4x, it would add a significant amount to GDP growth. And what I want to end up with is just to talk about personal savings in the U.S. On the left here, you can see that savings jumped up significantly in 2020 and 2021, and I think a lot of that had to do with the economic stimulus that the government put out over those years. And so, the U.S. consumer has typically saved about $1 trillion annually over the last decade. And the past couple of years, that has been closer to 2.5 to 3 trillion. And we think this has put the U.S. consumer in a good position for the future, and given them the ability to navigate inflation. And on the right, net worth for U.S. households as a percentage of disposable personal income is very, very high. And in fact, it's the highest on record, not just in nominal terms, but relative to personal income. So for some perspective, the average post-World War II net worth versus disposable income is 550%. The last peak prior to this was in 2006 at 681%. As you can see now from the chart on the right, that number is close to 800%. So the net worth of U.S. households is in a much better position than we've seen historically. And I know that a big thought on this is well, on the other side, isn't debt higher than it has been ever before? So I'm going to end just by tackling that thought. So as you can see on the left, it's true that U.S. debt levels are very high. The total debt on the left, as you can see, is the total debt of the U.S. government, U.S. households, and corporations. The dark blue line shows the percentage, and the light blue area shows the total U.S. debt in trillions. In light blue, you can see that the total debt is around $63 trillion, and that the dark blue, even though it's come down a little bit over the last year or so, it's still nearly 3 times the U.S. GDP. Right now, it's at about 2.5 GDP, and half of that debt is government, and the others are split 50-50 between households and corporations. And as scary as this is the fact that it's rising like this. There's a couple of points that I'd like to make. The first off being that a lot of countries out there are worse off. Japan, European countries like Spain and Italy, their debts are up to 4 times their national GDP. And secondly, and most importantly, if we take a look at the chart on the right, the cost of servicing our debt is generally low and lower than it was 15 years ago. So that dark blue line in that chart represents the cost of serving that debt for households and corporations. So principal and interest payments relative to income, we can see is very low compared to history. And the light blue represents the cost of interest for government debt. Of course, higher interest rates may make these lines go up, but generally, households and corporations are in a very fine position just because they have their debts turned out further. And I think the overall point here is that the servicing of the debt is not soaring, and they're very manageable, even with higher interest rate risks, we think. And I'll finish off just by mentioning that 1/5 of the U.S. government debt is held by the Fed, so we're essentially paying interest to ourselves. So, a good chunk of that debt is not necessarily even debt. So I think just to wrap things up, and I'll pass it back to you, Brian. I think what we really wanted to get across is that we know that these are tough times. We know that nobody wants to see the market drop 20% in a short period of time, especially growth investors like Alger. But we do think it's important to stay the course. We do think it's important to not panic and sell out, just because, as we've seen, in the past, some of the best returns are after, steep drawdowns.
Well, Art, thank you for that. That was I was going to cut you off, say, because we're kind of coming here to the end, but man, that ending point was good. And I think, the last takeaway, and then I'm going to go into some last minute polls and some finished up housekeeping. But that's the one thing. I've talked to a couple of mortgage brokers that I know, and unlike '08, where there was a lot of headwinds, a lot of fear, we were starting to see a lot of foreclosures, which we're not seeing currently. And I like that one on the right to show that our debt is manageable. I'm not a big debt fan, but at least it's manageable, and we're not seeing the foreclosures that are going on. So thanks for finishing up on that, because I think that's a really good point. So, well, we finished our first webinar, but I do have a couple of polls and then a couple of housekeeping items that I just kind of wanted to get your input on. So we are truly testing different types of platforms to do these webinars on. We will more than likely use a different platform next time. But I do want to get your feedback on how was the use of this, of using this webinar platform. Was it easy? We got a few connection issues. Okay, so that's good. And that could, and for those who answered that, when we talk offline, we can kind of go through it and see if it's my issue or your issue. But I'm glad it was simple to get on. My hope is, if we do kind of change platforms, there's a couple of different ones out there that I'm looking at that give us a lot more options, is ones that will be like this one, where you basically just click a link and you're on a website. You're not having to download software. You're not having to do anything else like that. So again, a couple more questions here. What's the best time for the webinar? Now, we did one today in the morning at 11, trying to keep that, trying to be very consistent on that. And I love my question there, I don't care, which I like. Always know this: if you can't make it onto one of these webinars, we are recording this, and so you will be able to have access to it. You'll be able to share the link if there's somebody you think, because as I always value referrals from you, that it would be neat that if you handed out this webinar to other people and that sort of thing. And great, I appreciate that. And then last one is, the nice thing about this webinar is we're going to be able to cover a lot of topics. So I want to know for you how good Alger was today. I think they were great. I'll share feedback to Sean and Art later, after I talk to you guys one-on-one. But I'd like to kind of know what out there is something you would like to focus on. Do we want to talk insurance, long-term care planning, life insurance, et cetera, et cetera? Do we want to speak more on investments like we did today? Or is it more on just an economic view? Or we already have one answer on there, that it's financial planning. So, which is a good one. So we can go in there and do those types of webinars. So I do already have ours planned for the next couple of months. And then we could go into a financial planning one down the road. So just want to give you a heads up for next time. Next Monday next month in July, we have the webinar set up for July 14th. We will also be doing it at either 10 or 11 a.m. You will be receiving an email invite just like you did this time. Our presenter at this time, we're still in the process of making sure it gets all approved through our wonderful regulators and compliance, will be Paul Hoffmeister with Camelot Funds. He is the portfolio manager of the mutual fund that all of you have in your portfolio, EVDIX. So we're very fortunate to be able to have a portfolio manager on. So that'll be for next month's webinar. But again, to finish up today, I want to just thank Sean and Art for helping me with this. They were our guinea pigs to do the very first one, and I think they did a great job. So again, can't thank you enough for the partnership we have with Alger, and for all of you who took time out of your morning. I really appreciate you taking your time. And as always, if you have any questions, concerns, comments, email me, give me a call, and I'd be more than happy to get together with you soon. Take care, and thank you for your time.